For decades, enforcing the U.S. tax code relied heavily on human labor. Revenue agents traveled directly to homes and businesses, conducting face-to-face field audits and sifting through physical ledgers to verify compliance. To address the massive deficit between taxes owed and taxes paid, known as the tax gap, the IRS replaced those physical deployments with automated data matching software. This algorithm-driven approach drastically expanded enforcement reach. Audit coverage for individuals earning under $100,000 surged from around 1% to nearly 7%. The volume generated by this system is managed by 10 massive, centralized IRS campuses spread across the country, dismantling the traditional model of a local agent working a single taxpayer file. Practitioners defending clients against these actions must recognize that the automated system operates on two distinct procedural tracks, each with its own rigid rules and legal vulnerabilities. These two tracks are correspondence examinations, commonly known as court exams, and the Automated Underreported, or AUR, program. Treating a correspondence exam the same as an AUR inquiry is a procedural error that immediately places the taxpayer at a disadvantage. To evaluate these systems, we need to map their separate pipelines. The correspondence exam track triggers when claims require substantiation within a tightly defined scope. The algorithm flags individual line items, such as Schedule C business expenses, earned income tax credit claims, or Schedule A deductions. The system demands physical evidence to back up the claim, birth certificates to verify dependents, or canceled checks to prove a charitable contribution. The Automated Underreported track has a completely different objective. It ignores deductions, hunting for omitted income. The algorithm executes a massive cross-reference. It compares the taxpayer's self-reported individual master file against the information returns master file, the database of W-2s, 1099s, and other income documents submitted directly by employers and banks. Because third-party documents flow into the IRS year-round, this matching process operates with a built-in delay. The system waits until all information returns are processed to ensure the match is accurate. As a result, the earliest an AUR contact is generated is typically a full 12 months after the return is filed. A correspondence exam demands proof of the numbers you claimed. The AUR program demands an explanation for the numbers you left out. Since revenue agents are removed from the initiation phase, both tracks communicate exclusively through rigid, escalating sequences of automated notices. The correspondence exam sequence begins with letter 566. This is an initial contact specifying the targeted line items and requesting documentation. If the taxpayer ignores the request or the provided proof is deemed insufficient, the system automatically generates letter 525. This document serves as a formal 30-day letter. If the IRS does not receive a response within 30 calendar days, the proposed tax liability is immediately assessed. On the AUR side, an income mismatch triggers notice CP2000. It quantifies the discrepancy and asks for an explanation, but doesn't propose a tax liability change. If the taxpayer fails to respond, the system escalates to notice CP2000. The CP2000 computes the exact tax understatement and applies downstream adjustments to the taxpayer's adjusted gross income, acting as a binding 30-day letter. Practitioners often make a critical error here. Instructing a client to file an amended return in response to a CP2000 creates administrative chaos. The required procedure is to complete the response section of the notice itself. Mistaking a preliminary CP2501 for a final assessment, or treating a CP2000 like a standard request for information, locks the client into automated penalties and severely jeopardizes their appeal rights. This automated architecture faces severe institutional criticism, most notably documented by national taxpayer advocate Nina Olson. Her primary critique focuses on the staffing model. These consequential audits are processed entirely by entry-level tax examiners, a role requiring only a high school diploma or GED, rather than specialized revenue agents. Furthermore, the IRS phone queues are overloaded. Calls are routed to whichever examiner is available next, eliminating any single-point accountability for a given case. But the most hazardous legal mechanism in this paradigm applies directly to the Automated Underreported program. The IRS takes the position that an AUR contact is not legally an examination of books and records. They classify it merely as a request for the taxpayer to explain a discrepancy. Because it is technically an unreal exam, The IRS can bypass Internal Revenue Code Section 7605B. This statute protects taxpayers from being audited twice for the same tax year. By defining the AUR contact as something else entirely, the IRS reserves the right to conduct a full, traditional audit later. These algorithmic enforcement tools place taxpayers in immediate financial jeopardy, all while systematically denying them the statutory protections guaranteed during a formal audit. Because the campus system is highly fragmented and so heavily reliant on paper correspondence, your defense strategies must be rigidly documented. Upon client intake, the immediate first step is executing and filing Form 2848, the Power of Attorney and Declaration of Representative. File in this form grants the practitioner standing to use the Practitioner Priority Service hotline, completely bypassing the massive queues on the general public lines. When submitting evidence, the rules are absolute. Never send original documents. Every page should be clearly stamped, "Copy only, do not process," preventing the automated system from mistakenly assessing the records as a new filing. You must manually direct the algorithmic system. Every piece of correspondence needs to explicitly state the requested action, whether that is abate penalty or request appeals office consideration. The necessity of this aggressive intervention is visible in the data regarding the Earned Income Tax Credit. Taxpayers who utilized professional representatives to navigate the correspondence process were nearly twice as likely to retain their credits compared to unrepresented taxpayers facing automated disallowance. In an environment defined by faceless enforcement algorithms and fragmented staffing, precise procedural knowledge is the only definitive shield a practitioner can provide.